Welcome to another episode of Delta Investments Deep Dive, where we go in depth and unpack our research on specific stocks and discuss the risks. I'm Marcus, and I'm joined by my co-host Sloan. Today is Sunday, March 15, 2026. And, as we sit down and record this, I want to set the stage for you, the listener. We aren't here to talk about the obvious headlines today. We're here to talk about the collateral damage and the hidden opportunities that arise when the global board is reset.
Right.
Today, our focus is Robinhood Markets, Inc. And I want to speak directly to you for a moment. If your mental model of Robinhood is still anchored in that 2021 narrative.
The meme stocks.
Yeah, exactly. The meme stocks, the gamification, that whole pandemic trading boom where everyone was suddenly a Dogecoin millionaire. If that's what you think of, you are looking at a ghost. That version of the company is, it's dead and buried.
Completely gone.
What we are going to do today is bypass those outdated, frankly, lazy narratives. We want to uncover the psychology, the first principles, and the incredible structural operating leverage that is transforming Robinhood into what they are explicitly calling a financial super app.
I think the phrase financial super app gets thrown around far too casually in Silicon Valley pitch decks.
Oh, absolutely. Every startup says it.
Right. But when you look at the sheer velocity of the capital they are deploying, the infrastructure they are replacing, the metamorphosis over the last 3 to 4 years is just staggering. We are looking at an organization that has methodically, almost ruthlessly reconstructed its entire identity.
And they did this while the legacy financial world, the bulge bracket banks, the traditional brokerages, they were still treating them like a passing fad, like a novelty for college kids.
Exactly. It's the classic innovator's dilemma playing out in real time. The incumbents always mock the disruptor until the disruptor is suddenly processing billions of dollars of their core business.
Yeah. But to truly understand the micro-level decisions Robinhood is making, we have to pull the lens way, way back. The broader ecosystem is shifting violently right now. What is the uncomfortable reality that CEOs in the financial space are waking up to this year?
The deeply uncomfortable truth, the realization that is genuinely keeping legacy banking executives awake at night, is that the very foundation of their profit margins is being automated away by a convergence of 3 massive macro trends.
Okay, let's unpack those.
So the first, which is hitting with a speed I don't think anyone modeled accurately, is the arrival of agentic AI and autonomous finance. Let's strip away the noise and the buzzwords. The terminology is really important. For the last 2 or 3 years, the financial industry has been completely obsessed with generative AI.
Right, the whole chatbot era. Like write me an email to a client or summarize this quarterly earnings call.
Exactly. And while that has utility, it was essentially a parlor trick for productivity. It wasn't fundamentally changing the economic model of finance. But as we sit here in 2026, the industry has moved violently past the hype cycle.
Yeah, they want real results now.
Right. Boardrooms are demanding disciplined, measurable return on investment through enterprise-wide deployment. We have shifted from simple language models to autonomous digital coworkers. These are agentic systems. They don't just generate text. They have the authority and the agency to execute workflows and manage compliance independently.
I want to pause on that word, agency.
Yeah.
Because there is a profound psychological leap required from the consumer here.
Huge leap.
It's the leap from asking a machine, tell me what the S&P 500 did today, to saying, analyze my specific tax bracket, my risk tolerance, parse the geopolitical news out of Europe this morning, and autonomously execute a portfolio rebalancing strategy before the market opens.
And that psychological leap is exactly what Robinhood is banking on crossing. They are deploying AI in 3 distinct, very deliberate phases. The first was entirely internal, augmenting their own engineering and compliance operations to drive down fixed costs. The second phase was enhancing customer-facing products with better search and discovery. But the third phase, this is the paradigm shift, is the development of sophisticated autonomous financial agents. Look at the architecture of what they've introduced with Robinhood Cortex.
Cortex is fascinating.
They are building AI-native advisory products. These aren't just passive tools. They are producing portfolio-level digests. And the investing assistants offer real-time quantitative analysis that identifies arbitrage opportunities and parses market-moving news instantaneously.
Let's unpack the psychology of that and the threat it poses. Because if you look at a legacy wealth management institution, your Morgan Stanleys, your Merrill Lynch's, their entire business model, their cathedral, is built on a very specific human interaction.
A mahogany desk.
Yes. It relies on a human advisor sitting across a mahogany desk from you, maybe taking you out for a round of golf,
Right.
asking about your kids. And in exchange for that emotional security, they charge you a 1% assets under management fee every single year.
That 1% AUM is the lifeblood. It's the absolute golden goose of traditional wealth management. It is an incredibly sticky, recurring revenue stream that just compounds as the market grows.
So the uncomfortable truth for those incumbents is that these autonomous AI assistants are democratizing the kind of quantitative, personalized, deeply analytical advice that was previously reserved for hedge funds or, people with $50 million in a family office.
Right.
And Cortex is doing it for a fraction of the cost. The moat that legacy banks built around professional advice is evaporating because the advice is no longer scarce.
The scarcity was always artificial. It was based on the limits of human bandwidth. I mean, a human advisor can realistically only manage perhaps 150 to 200 relationships effectively.
Right, there's only so many hours in a day.
Exactly. An agentic AI can manage 10 million relationships simultaneously with perfect memory, zero fatigue, and real-time ingestion of global macroeconomic data. If a machine can analyze your portfolio, contextualize it against a sudden interest rate hike in Japan, and suggest risk-adjusted adjustments instantly, the fundamental question becomes, why are you paying someone tens of thousands of dollars a year to look at a spreadsheet once a quarter and tell you to hold a 60/40 portfolio of index funds?
Robinhood Cortex is designed as a direct, lethal attack on that exact inefficiency.
Yes.
But there is something deeply unsettling about it, though. Handing the keys of your financial future over to an algorithm, there was a trust deficit there. Like when the market is down 20%, human beings want someone to call and yell at, or someone to talk them off the ledge. Can an AI talk you off the financial ledge?
That is the behavioral hurdle, and it's exactly why Robinhood isn't forcing full autonomy on day one. They are building a co-pilot model first. The AI suggests, the human approves. Over time, as the AI proves its competency and the user builds trust, they will naturally grant it more agency. It is a slow boiling of the frog for the legacy wealth management industry.
Which brings us to the second macro trend. And I actually think this is even more structural, more invisible, and therefore more dangerous to the incumbents. It's the new plumbing, the fundamental infrastructure of money itself. Digital assets, tokenization, and clearing.
Yeah, we are witnessing a fundamental rewiring of the global financial system's nervous system. For decades, the back end of finance has been this sort of Rube Goldberg machine of mainframes and batch processing.
It's ancient technology.
Truly. But following the legislative shifts we saw in late 2024 and 2025, particularly the comprehensive stablecoin legislation that finally provided regulatory clarity, banks are now actively integrating programmable smart money into their core payment and liquidity infrastructures.
And Robinhood is right in the middle of this.
They are. Robinhood is no longer just a participant trading Helto tokens. They are actively building the roads. They are developing the Robinhood chain, a permissionless layer 2 blockchain optimized specifically for real-world assets.
Let me stop you there.
Right.
If the listener who isn't spending their weekends reading cryptocurrency white papers, a permissionless layer 2 blockchain optimized for real-world assets is an incredibly dense string of words. Let's break that down.
Fair enough. Let's look at the baseline. The main blockchain networks, like Ethereum, are incredibly secure, but they are slow and expensive. Think of Ethereum as a congested single-lane highway. A layer 2 blockchain is essentially building an ultra-fast, multi-lane elevated monorail directly above that congested highway. It settles thousands of transactions per second for fractions of a penny, and then periodically drops a mathematically provable receipt of those transactions down to the main highway for permanent security.
I see.
What Robinhood is doing is building their own monorail, the Robinhood chain. Not just to trade Bitcoin or meme coins, but to trade real-world assets. Stocks, bonds, real estate, treasury bills, all represented as digital tokens.
And this is where the sheer audacity of their plan comes into focus. Let's think about the hidden costs of the current system. If I want to buy a single share of Apple stock today, I hit buy on my phone and it looks instantaneous. But behind the scenes, it's a nightmare.
A complete nightmare.
My broker has to talk to a clearinghouse, which talks to a transfer agent, which talks to a custodial bank. And the actual settlement of that trade takes an entire day, what we call T+1 settlement. And every single one of those intermediaries takes a tiny sliver of a penny. They extract rent just for moving database entries around.
The rent extraction is astronomical at scale. The Depository Trust and Clearing Corporation, the DTCC, sits at the center of all U.S. securities trades. It is a massive, centralized point of friction and risk.
Right.
Tokenization. Moving a share of Apple stock onto the Robinhood chain as a programmable token removes the need for almost all of those traditional financial intermediaries. The token is the asset, and the blockchain is the clearinghouse. The settlement is instantaneous, T+0. The result is a massive systemic reduction in operational costs.
It is a return to first principles finance. How do we transfer value from person A to person B with the absolute minimum amount of friction, time, and cost?
Exactly.
It makes me think about the broader arc of technological disruption. I want to test an analogy with you.
Go for it.
When I look at legacy banks trying to implement slightly faster batch processing systems to speed up their legacy clearing, it feels remarkably like Blockbuster in the early 2000s. Blockbuster saw Netflix mailing DVDs and thought, we just need to optimize our late fee model and open more physical stores. They fundamentally misunderstood the technology curve. Are legacy banks essentially acting like Blockbuster, while Robinhood is building the Netflix streaming infrastructure, the blockchain, that makes the physical store, or in this case the clearinghouse, completely obsolete?
I view it slightly differently, though the core of your analogy absolutely holds. It's not just that legacy banks are ignoring the streaming infrastructure. It's that their entire balance sheet and revenue model is so inextricably tied to the late fees, the overdraft fees, the clearing fees, the wire transfer fees. They cannot adopt the new infrastructure without cannibalizing their own massive profits.
They are victims of their own success.
Exactly. Robinhood, unburdened by legacy clearing revenue, is betting that the underlying architecture of capital markets will change entirely. By building the Robinhood chain, they are positioning themselves to capture the tokenization of traditional finance. When a U.S. Treasury bond becomes a digital token, they want to be the primary gateway and the underlying rails for that transaction.
Which perfectly sets the stage for the third macro trend, the democratization of private credit and institutional markets. For the last century, there has been a velvet rope in finance.
A very thick, legally enforced velvet rope.
Right. The public markets, the stock exchange, have been shrinking. The number of publicly listed companies is a fraction of what it used to be. The real life-altering wealth creation over the last 15 years hasn't happened in the public markets. It has overwhelmingly happened in the private markets.
Yeah, companies stay private much longer now.
Exactly. By the time Uber or Airbnb went public, the massive 10,000% gains had already been captured by venture capitalists and private equity firms. And traditionally, to get past that velvet rope, you had to be an accredited investor, which is basically a polite regulatory way of saying you already had to be incredibly rich to be allowed to get richer.
It is a walled garden, justified historically by the idea of investor protection. The logic was that private markets are opaque and risky, so only those who can afford to lose their capital should be allowed to participate. But the unintended consequence is massive wealth inequality. The average retail investor was simply locked out of the highest performing asset classes of the 21st century.
And now Robinhood is essentially bringing a sledgehammer to that wall. Traditional corporate lending continues to migrate toward private funds, and Robinhood is tapping into this. They recently launched the Robinhood Ventures Fund of First. Let's dig into the mechanics of this because it's not just a feature update.
No, it's a huge structural shift.
This is a closed-end fund trading on the New York Stock Exchange that gives retail investors direct fractional exposure to private frontier companies.
The structural shift here is profound. They are raising capital from their massive retail user base, pooling it into a publicly traded vehicle. But Robinhood itself is acting as the underwriter. They are rigorously sourcing deals, conducting due diligence with a strict fiduciary obligation, and investing that pooled capital into early-stage private tech companies, space exploration firms, advanced robotics, the kind of deals normally reserved for Sequoia Capital or Andreessen Horowitz.
And they have integrated this seamlessly into the UI. They're offering private company detail pages directly in the app.
Right.
You can search for a private aerospace company, look at its valuation history, read publicly available financial summaries, and gain indirect exposure through the fund all in one place. They are systematically collapsing the moat around accredited investing.
And we are seeing this democratization extend beyond just private equity. It's happening in the event contract space too, the prediction markets.
Okay, now I need to pause here and be abundantly clear with you, the listener. We are going to talk about prediction markets, which often involve political event contracts. Whether we are discussing platforms like Kalshi, Polymarket, or Robinhood's own massive push into event contracts through their joint venture Radhra and their acquisition of Mia XDX, we are maintaining strict absolute political neutrality.
Yes.
We do not endorse the viewpoints, the specific outcomes, or the political leanings of any specific event contracts. We are looking at this strictly as analysts, analyzing the raw market mechanics of trading event outcomes.
That is a crucial distinction because from a purely mechanical, architectural, and business perspective, the explosion of the prediction market is arguably the most fascinating behavioral finance study of the decade. Let's look at the sheer volume. Robinhood facilitated the trading of over 12 billion event contracts in 2025 alone.
12 billion, that is insane.
It is. They didn't just add a feature, they established an entirely new joint venture, Rothera, to build out an independent CFTC licensed exchange and clearinghouse specifically for event contracts.
Why go through the immense regulatory headache of building a CFTC licensed exchange from scratch?
Because an event contract, at its core, is just another financial asset. It is a derivative. It is a mechanism for a human being or an institution to hedge risk or express a viewpoint on a future outcome, utilizing the wisdom of the crowds to discover a probability price.
Right.
Whether that outcome is an interest rate decision by the Fed, the winner of a major sporting event, or a geopolitical election, the mechanical need is the same. By bringing preset and custom combos and even player contracts heavily into the SuperApp ecosystem, they are ensuring one vital thing. If a user has an opinion on the future and wants to put capital behind it, they never have to leave the Robinhood application to do it. It is about capturing 100% of the user's financial attention.
So we've established this incredibly aggressive macro environment, a world where AI is replacing the human wealth advisor, where blockchain architecture is replacing the legacy clearinghouse, and where retail investors are suddenly accessing private venture capital and global prediction markets. The environment is incredibly chaotic. Now let's bring it down to the micro. Let's look at the actual numbers. And on the surface, the numbers look great. But when you look at Robinhood right now, what is the untold story behind their balance sheet?
If we strip away the noise and the headline top-line beats, the untold story is the sheer velocity and scale of their revenue transformation. The fundamental DNA of how this company makes a dollar has completely mutated.
Okay, let's establish the baseline numbers for the full year of 2025.
They hit a record total revenue of $4.5 billion. That is up 52% year over year. Q4 alone was a record $1.28 billion. Those are staggering growth figures for a financial services company.
They really are. But to your point, it's not just the top-line growth that caught my eye, it's the internal composition of that revenue. The psychology of the revenue mix has completely flipped.
It really has. If we look back a few years, the entire institutional bear case against Robinhood, the reason traditional analysts were constantly predicting their demise, was that they were far too reliant on transaction-based revenues.
Specifically, payment for order flow, or PFOF.
The argument was simple. Robinhood only makes money when retail traders are manically buying and selling stocks and options. If the market goes sideways, if retail loses interest, or if volatility dries up, Robinhood's revenue would crater. It was viewed as a fragile, transaction-based model entirely reliant on market exuberance.
The 2025 data destroys that narrative. Net interest revenues reached a massive $1.51 billion. That is up 37% for the year, and it now represents a massive stabilizing pillar of their business.
Absolutely.
Let me play devil's advocate for a second, though, because I struggle to see how that isn't just a temporary macro windfall. A huge portion of that $1.51 billion in net interest revenue comes from the interest they earn on corporate cash, the interest they earn by sweeping customer cash balances into partner banks, and the interest they charge on margin lending.
Yeah.
We have been in a relatively elevated interest rate environment. What is the hidden cost of this strategy? If the Federal Reserve is forced to begin aggressively cutting rates to stave off a recession, if we return to a zero-rate or low-rate environment, doesn't a massive chunk of that $1.5 billion just vaporize overnight?
It is the exact logical pushback that every institutional analyst has modeled in their spreadsheets. And yes, in a vacuum, if rates go to zero, net interest margin compresses significantly. But if you look at the first principles of how retail behavior actually functions, there is a fascinating, almost paradoxical internal hedge at play in Robinhood's specific ecosystem.
Tell me more.
CEO Vlad Tenev has articulated this theory quite forcefully. Historically and psychologically, a low-interest rate environment actually acts as a massive behavioral spur for retail trading volume.
Oh, because when yield is impossible to find in safe haven assets like a standard savings account, capital is starved for return. It is forced to march further out on the risk curve to find yield.
Exactly. When rates drop to near zero, holding cash is essentially losing money to inflation. So that capital flows into equities, into options, into volatile tech stocks, and into crypto. Therefore, while a low-rate environment will inevitably compress their net interest revenue, that exact same macroeconomic condition stimulates a massive boom in equity, options, and crypto trading, which drives their transaction-based PFOF revenues through the roof.
That's fascinating.
10 have pointed out that Robinhood originally proved its massive earning strength in a zero interest rate environment when they went public a few years ago. The business model, purely by the nature of consumer psychology, has a built-in macroeconomic counterbalance.
That makes profound sense when you view it through a behavioral lens rather than just a purely accounting lens. So the top line is growing and internally hedged, but revenue is vanity and profit is sanity. What does this all mean for their bottom line?
This is where the structural operating leverage of the company truly shines, and frankly, it's where legacy brokerages look absolutely ancient by comparison. In 2025, Robinhood delivered a net income of $1.9 billion and a diluted earnings per share of $2.05.
Wow.
But the metric that truly tells the story of their operational efficiency is their Adjusted EBITDA. Earnings before interest, taxes, depreciation, and amortization. It hit $2.5 billion. That represents an incredible 56% margin.
Let's pause on that number. A 56% margin. That is not traditional bank territory.
Huh.
Traditional banks are thrilled with 20 or 30%. A 56% margin is pure sauce. Software as a service territory. It's the kind of margin you see at Microsoft or Adobe, not a brokerage firm dealing with physical money and intense regulatory compliance.
And we have to deeply unpack why those margins are so exceptionally high, because it isn't an accident. It all goes back to incredibly difficult engineering and strategic decisions they made years ago. Robinhood operates on a nearly 90% fixed cost base.
90%.
Yeah. Think about a traditional legacy brokerage. They often rely on third-party clearing firms to actually settle their trades. Every time a customer buys a stock, the brokerage pays a small toll to that third-party clearing firm. As volume scales, their costs scale linearly. Robinhood rejected that model.
They built it themselves.
They spent years and hundreds of millions of dollars building a proprietary, completely cloud-native self-clearing system called Robinhood Securities, built entirely from the ground up on Amazon Web Services.
I cannot emphasize enough how critical that architectural decision was. By self-clearing, they own the entire vertical stack. They aren't paying a toll to a middleman every single time a user buys a fractional share of Tesla.
Precisely. It gives them intense internal visibility, stronger regulatory oversight, and crucially, massive, almost unassailable operating leverage. Because their costs are mostly fixed, they already built the clearing engine, they already pay for the AWS servers, every incremental dollar of revenue they generate doesn't come with a corresponding increase in expenses. It falls almost entirely straight to the bottom line. If they add 1 million new users tomorrow, their AWS server compute costs might tick up marginally, but they don't have to lease new office space, they don't have to hire 1,000 new human brokers to service those accounts, and they don't pay more clearing fees. The machine just processes it. That is the definition of operating leverage.
So that explains the jaw-dropping margins.
Yeah.
But a great machine is useless if nobody uses it. Let's talk about the stickiness of this ecosystem. Because acquiring a user is one thing. Giving them a free stock to download the app is easy. Keeping them for a decade is incredibly hard.
The stickiness is showing up vividly in two major metrics: subscribers and assets. Robinhood Gold, their premium subscription tier, hit a record 4.2 million subscribers in 2025. That is up 58% year over year. Net deposits, meaning fresh capital flowing into the system from outside banks, was a record $68 billion for the year. And total platform assets reached a staggering $324 billion.
Let's dig into the behavioral economics of that gold subscription, because I noticed a fascinating strategic pivot in the data. In late 2024, they actually wound down and eliminated their 1% deposit boost promotion. For a long time, if you paid for gold, they would give you a 1% match on any money you deposited. Why kill it if growth was the goal?
They killed it because they are intensely data-driven, and the data told them it was fundamentally flawed. They realized it was driving contra revenue. It was essentially a massive marketing expense that was eating into their margins, but it wasn't actually driving sticky long-term customer activity. A user would deposit cash, take the 1% match, and let the money sit. It didn't change their daily behavioral relationship with Robinhood.
But then you look at what they replaced it with. The Robinhood Gold Card, the physical, solid metal credit card that offers a flat 3% cash back across the board. The psychology here is brilliant.
It really is.
They realized that a 1% deposit match in a brokerage account feels abstract to a user. It's just numbers on a screen. But pulling out a heavy physical metal card at a restaurant, dropping it on the table, and knowing you are getting an unconditional 3% cash back on that dinner, that is intensely tangible. It creates a daily, physical, emotional connection to the brand.
And the behavioral data supports that thesis completely. They are seeing approximately 95% retention of Gold Card customers following the very first transaction. It is rapidly becoming the top-of-wallet card for these users.
Right.
And here is the deeper strategic play, the real Trojan horse. By capturing the credit card relationship and driving users into the Gold subscription ecosystem to get that card, they are successfully capturing the holy grail of finance, the primary banking relationship. When your paycheck is direct deposited into Robinhood to earn high yield, and your daily coffee and grocery spending comes out of Robinhood via the Gold Card, you are no longer just a weekend options trader. You are a lifetime, sticky banking customer.
Which significantly lowers the churn rate and increases the lifetime value of the customer exponentially. But we can't ignore the risks here, because credit is a dangerous game. What is the hidden cost of this rapid expansion into unsecured consumer credit?
The uncomfortable truth in the balance sheet, the shadow side of this incredible growth, is that scaling a credit card business is wildly expensive, and consumer credit carries profound, inherent macroeconomic risk. To support this massive expansion of the Gold Card, their operating expenses grew 38% in Q4 of 2025 alone, hitting $633 million.
That's a huge jump.
But far more concerning for risk analysts is the line item for the provision for credit losses. That number jumped 89% in Q4 to $36 million.
Let's clarify that for the listener. That provision is a direct result of scaling the Gold Card. As you issue more plastic, or in this case metal, and extend billions of dollars in credit lines to consumers, you have to legally set aside more cash to cover the inevitable percentage of people who simply won't pay their bills.
Exactly. It's an anticipated loss. And the existential question we must ask is, what happens if the macroeconomic consumer credit cycle aggressively turns? We have been in a relatively resilient consumer environment. But if unemployment ticks up from 4% to 6%, or if inflation bites harder and drains household savings, consumer defaults on credit cards will spike violently. Robinhood is venturing deep into a space where traditional legacy institutions like Chase or American Express have literally decades of proprietary underwriting experience and historical data through multiple recessions.
And Robinhood is learning as it scales.
It is a calculated risk, but a massive one. Furthermore, they are aggressively returning capital to shareholders right now. They announced a $1.5 billion share repurchase authorization, and they actually deployed $653 million to buy back 12 million shares in 2025. At an average price of $54.30.
Buying back stock at $54 a share shows immense executive confidence in their valuation.
It does, but it also drains highly liquid cash from the balance sheet. Cash that might desperately be needed as a buffer if the consumer credit environment rapidly sours. It is a delicate balancing act between rewarding shareholders and fortifying the fortress.
So we have this incredibly complex picture. A company with exploding diversified revenues, jaw-dropping operating leverage due to self-clearing, but expanding unseasoned consumer credit risk. Now let's look out over the horizon. If you look at their playbook for the next 5 years, what is the ultimate endgame here?
The ultimate endgame, the absolute grand prize they are hunting, is to capture the largest generational wealth transfer in human history. Let's look at their strategic moves, starting with the institutional and wealth preservation pivot. In 2025, they executed two massive, highly revealing acquisitions, Bitstamp and Trade PMR.
I want to break these down sequentially because they tell two very different but interconnected stories about Robinhood's maturation. Bitstamp is a globally scaled, highly compliant crypto exchange. It isn't a flashy retail app. It has deep institutional client roots and global regulatory licenses. But Trade PMR, this one is fascinating. Trade PMR is a custodial platform for registered investment advisors, or RIAs.
This is where we have to completely strip away the noise of the colorful mobile app and look at the underlying demographic plumbing. The acquisition of Trade PMR is a brilliant, long-term Trojan horse.
Also,
Think about Robinhood's core demographic, millennials and Gen Z. They acquired tens of millions of these users when they were in their early 20s, trading fractional shares with a few $100s. But over the next 2 decades, these specific generations are going to inherit an estimated $80 trillion from the baby boomer generation.
80 trillion. It is an incomprehensible amount of capital moving from one generation to the next. And as those Robinhood users age into their 30s, 40s, and 50s, their financial lives inevitably grow infinitely more complex. They get married, they buy homes, they have children, they start businesses. Suddenly, a simple app isn't enough. They need complex family trusts, they need sophisticated tax loss harvesting, they need estate planning, they need human advisory.
Historically, that is the exact moment legacy brokerages pounce. The user ages out of the starter app and moves their millions of dollars in inherited wealth to Charles Schwab, Fidelity, or a white-glove wealth management firm. Robinhood bought Trade PMR specifically to stop that bleed.
That makes perfect sense.
An RIA, or registered investment advisor, is a fiduciary. They are legally obligated to act in the best financial interest of the client. Trade PMR provides the back-end software and custody services that these independent financial advisors use to manage their clients' money.
It reminds me of Apple's ecosystem strategy from 20 years ago. Apple hooked teenagers with the iPod. It was simple, fun, accessible, but they didn't want you to leave when you grew up, so they built the MacBook, then the iPhone, then the entire iCloud ecosystem. Once you are in, the friction to leave is immense. Robinhood is doing the exact same thing with wealth.
Exactly the same playbook.
They hook you in your 20s with zero commission fractional shares of tech stocks, and by the time you are 45 and inheriting a $2 million estate, Robinhood connects you with a professional fiduciary RIA who manages your family trust using Trade PMR software, and your assets literally never leave the Robinhood ecosystem. It is a masterful generational retention strategy.
It is the definition of aging up with your consumer base. But importantly, they aren't abandoning the active trader. That covers the wealth preservation side. But we have to look at the other extreme of their user base, the hardcore, hyperactive traders. Because Robinhood has recently launched a suite of tools that, on the surface, seem entirely counter to their original ethos of ultimate simplicity.
Yeah, they launched Robinhood Legend.
Right, which is a highly complex desktop web experience for pro traders. They rolled out futures trading, index options, and in late 2025, they finally rolled out short selling.
I really struggle with this strategic move. Let's look at the psychology here. Robinhood won the market by making finance incredibly simple. The app was elegant, minimalist, unintimidating. It democratized access because it didn't look like a Bloomberg terminal. If you start adding perpetual futures, margin lending, short selling, moving average divergence charts, and complex event contracts, do you risk alienating the everyday learner? Do you risk making the app look like the terrifying complex cockpit of a 747 airplane?
It is the absolute classic innovator's dilemma in product design. How do you serve the demanding power user without completely terrifying the novice? The psychology behind this aggressive expansion into pro tools is rooted in loss aversion on Robinhood's part. For years, they successfully acquired millions of novice investors. But as a small percentage of those investors became highly sophisticated, ultra-high net worth active traders, they inevitably hit a capability ceiling on the mobile app.
They outgrew the sandbox.
Exactly, and so they bled out. Those highly profitable, hyperactive accounts moved to legacy pro platforms like Interactive Brokers or Thinkorswim because Robinhood simply lacked the professional-grade execution tools they needed. By adding margin lending, perpetual features in their European markets, complex index options, and the deeply customizable Robinhood Legend desktop platform, Robinhood is systematically, ruthlessly removing every single excuse a professional trader has for leaving the ecosystem. They were saying, we don't just want your starter portfolio, we want 100% of your active trading wallet share.
But the risk remains. Complexity breeds confusion. And in finance, confusion breeds catastrophic losses. If a novice user accidentally wanders into the short-selling interface, borrows shares of a highly volatile meme stock, and faces literally infinite downside risk when that stock squeezes upward, the financial ruin for that user and the resulting reputational and regulatory damage to Robinhood could be severe.
It is a massive risk, and it requires intense, foolproof guardrails and user education. Robinhood is attempting to solve this through a strategy of bifurcation. The core mobile app remains relatively streamlined and clean for the buy and hold investor, while Robinhood Legend exists primarily on the desktop for the hardcore quant trader.
That makes sense. Keep them separated.
Furthermore, they are leaning heavily on Robinhood Learn modules and, crucially, integrating that Cortex AI assistant we discussed earlier to actively warn users about the risks of specific complex trades before execution. They are trying to build software guardrails to replace the traditional human broker's warning.
That brings us to perhaps the most existential, slow-moving strategic threat of all: regulatory chess and the future of payment for order flow.
Yeah, the regulatory tectonic plates are shifting under their feet, and it's happening globally. PFOF, the mechanism where market makers like Citadel Securities pay Robinhood a fraction of a penny for the right to execute retail trades, has been under intense hostile scrutiny from the SEC and global lawmakers for years. And while outright bans haven't materialized in the U.S. market yet, the regulatory noose is tightening. The new SEC tick size and access fee cap rules taking effect in November 2025 are explicitly designed to contract the bid-ask spreads across national securities exchanges.
Let's break down the mechanics of that, because it sounds like arcane Wall Street plumbing, but it directly impacts Robinhood's bottom line. When the SEC forces a smaller tick size, meaning the minimum price movement of a stock is smaller, it compresses the spread between the buy price and the sell price.
Correct. And when that spread compresses, the market makers make less profit on every trade. And if the market maker is making less profit, they mathematically have less margin to kick back to Robinhood in the form of PFOF. Robinhood explicitly notes in their 10K filings that these new rules will likely lead to a structural, permanent decrease in their PFOF revenue.
So, if the golden goose is sick, how do they respond?
They play defensive, multidimensional chess. Look at their crypto business. In anticipation of regulatory conflict of interest concerns regarding order routing, they are actively moving their crypto operations toward a transparent, flat fee-based model instead of a liquidity provider rebate model. They are getting ahead of the regulators by essentially saying, we will just charge a transparent upfront fee rather than making money in the opaque back-end routing.
That is a massive philosophical shift in their DNA. Free trading, zero commissions was their entire brand identity. It was their battle cry.
It was. But the 5-year endgame requires survival and resilience above brand purity. By diversifying away from pure PFOF and by aggressively expanding into a global SuperApp, putting heavy footprints into the UK, the European Union, Singapore, and recently announcing massive infrastructure acquisitions to enter Indonesia, they're doing something crucial for their valuation. They're immunizing themselves against a single country regulatory crackdown. If the US SEC drastically alters or bans PFOF tomorrow, Robinhood will survive because they now have diverse, massive revenue streams from international crypto operations, sticky subscription fees from 4.2 million gold users, massive net interest income from their banking layer, and recurring advisory custody fees through trade PMR. They are actively building an anti-fragile revenue model.
Anti-fragile. I absolutely love that term. It perfectly encapsulates everything we've unpacked today. We've looked at a company that started as a simplistic, almost gamified app, and watched it evolve through intense disciplined operating leverage, the deployment of autonomous agentic AI, and a ruthless, forward-looking acquisition strategy into a globally diversified financial behemoth. They are methodically capturing the primary banking relationship, preparing to catch the largest generational wealth transfer in history, and bracing their balance sheet for a shifting, hostile regulatory environment.
The transformation truly is profound when you view it from a systems perspective. They have moved from being a mere participant operating on top of the legacy financial system to a company actively attempting to replace the underlying infrastructure of the system itself.
And that brings us to a final, slightly provocative thought for you, the listener, to ponder as we wrap up this deep dive. If Robinhood truly succeeds in its ultimate mission, if they successfully build the Robinhood chain and fundamentally replace the deeply entrenched rent-extracting plumbing of traditional finance through total tokenization, what does that mean for your own financial identity?
It's a huge question.
In 5 years, will your local brick-and-mortar bank branch, your legacy brokerage account, and your exclusive venture capital firm simply be 3 different tabs inside the exact same decentralized app on your phone? And more importantly, are you prepared to trust an autonomous algorithm with the keys to your financial future?
It is a future that is arriving much faster than the incumbents realize, and the fiction of the past will not protect them.
We hope you enjoyed this deep dive, and thanks for listening. Please follow us and subscribe on your favorite platforms. Don't forget to check out our Substack, Delta Investments. Until next time.
This analysis is based on publicly available information and does not constitute financial advice. Always conduct your own research before making investment decisions. By listening to this podcast, you agree that you are in charge of your own decisions and risks, and that you are solely responsible for any investment decisions you make.